Hi, good morning. Well, at least it is here on the West Coast. From actually very windy Palm Springs. We have missed you guys. We haven't done one in a little bit. We have a lot of announcements, and today we are going to cover a lot of different things, which we have in the title. We're going to cover the Dow. We're going to cover the US dollar. We're going to cover interest rates. We're going to cover the bond market and naturally Bitcoin. So we're going to start with some announcements because we are almost filled up with Consensio webinar, but let me turn to Tyler for that one. All right, Tyler.
Great. Hello, everybody. Thank you for tuning in. This is pretty important today because a lot has been going on in the traditional markets. Absolutely nothing's going on with Bitcoin. A little bit is going on with GBTC, but we've been talking about it and tweeting about it and talking about the falling premium. We're going to look at all those things today. We're going to look at GBTC. We're not going to spend any time on Bitcoin because it's, dead as a doornail. It's just going sideways. Something big is about to happen, either up or down. But that's not for today. We do want to talk about the U.S. stock market, and we do want to talk about world markets, and we do want to talk about interest rates because some very, very interesting things are beginning to happen, and they have implications for a lot of other things. And Leah's been kind enough to build a number of charts for us that will be a precursor to our Consensio, because we're going to look at Consensio relative to all the things I just talked about. And in our webinar coming up a week from today, we will be looking at all these same things in great detail. And also a number of our consulting clients have asked in the Consensio meeting to use actual examples of things that we have been recommending to those clients. And we're going to do that, showing you how to use these moving averages that we call Consensio for making decisions in markets such as the ones we are in right now, with big drops in all of the indexes, big drops in technology, wild swings in individual stocks like Tesla and Netflix and Amazon and Facebook. This is the time where this concept Consensio of stepping out of positions or into positions incrementally makes a lot of sense. And that will be a week from today. If you have not signed up, there are very few seats left. We are maxed out at 100 because that's all we can do in the Zoom, the way we've got it set up, and we're almost there. So if you would like to join the 3-hour webinar on Consensio, please go to lucidfunds.com and you will see there a place to access information about the webinar and to just fill out a form that says you would like to register. It will explain we are charging $150 for the 3 hours. For consulting clients, that's 50% off of that amount, but you can sign up through the website, and Leah will quickly respond to every one of you and make sure that you get in until it's filled up at 100, which will probably be in the next day or so. Okay, the other thing is thank you all who have joined our consulting clients. We said that we would be cutting that off as a program because of the amount of time that it takes for me to work with each one of you individually. And we will be doing that before the end of this year, probably before the end of October. So anybody that is considering what does that mean to be a consulting client, please just go to the website, lucidfunds.com, and you can read about consulting, and you can also put in a request for more information. And once again, Leah will make sure that you receive that. Okay, enough of the advertisements. What we're going to do is we're going to just move to some charts. And the only thing that we've got on these charts is weekly prices and 3 moving averages. And they're the 3 moving averages I usually use on a weekly basis for consensio analysis to see where we really are in the big picture. So I'll ask Leah to bring those up and we'll take them one at a time. And the first one we're looking at is the Dow Jones Industrial Average. This is a weekly chart. You can see the 3 moving averages. You probably only closely see 2 of them. If you look very closely, right in the middle of all the price activity, you'll see the 3rd line. So that's the short term, the intermediate term, and the long term moving averages that I use, which are the 2-week, the 7-week, and the 30-week. All right, we're looking throughout 2018 back into 2017, and we see from the left of the screen that the Dow Jones had run up from 17,000 all the way up to 25,400 between the beginning of 2017 or the middle of 2017 and January of this year. And you probably remember that I started getting nervous about the US stock markets because of what happened in January and February, where the uptrend came to an end. The price dropped from the highs down through the short-term moving average and came and touched the intermediate term moving average on that big red candle at the beginning of February. Actually, it was January 22nd. Then the next candle broke down through the intermediate moving average. And then we went sideways for 5 weeks, but couldn't make any more upward movement. And I started getting nervous that, in a sense, that looked to me like the beginning of a major correction, but we would just have to wait. But I didn't wait for my clients. At the time, we did not have any consulting clients, but my fiduciary clients, where I make all of the moves without discussing it with the client, I began to raise cash in Dow-related stocks. And I did it incrementally. By the first time we broke through the intermediate moving average, I raised cash. And in different types of clients, we raised different amounts of cash, but let's use the number 10%. So from being 100% invested prior to January of 2018, why was I 100% invested? Because my definition of a bull market is when all 3 of these moving averages are moving up, and each one of them are higher than the next in line. The short is above the intermediate is above the long, and they're all moving up. But that came to an end in January because price dropped down through the short-term moving average, and the short-term moving average turned down. And then the next week, after touching the intermediate moving average, price dropped through that. And that's the point at which I raised money. 5 weeks later, we were going sideways, but look what happened to the intermediate term moving average. Because the price could not get above it, but was below it, it turned down. The blue line turned down as price was going sideways. So I raised an additional 10% into cash out of Dow-related stocks. Then we had a candle that broke above the declining intermediate term moving average, but then turned negative, and the following week broke back down below it. And that week, which occurs in, it looks like late March or early April, the price dropped below the long-term moving average. And 5 weeks later, the intermediate blue moving average dropped below the long-term moving average. That's as bad as it gets in an uptrend. We're still in an uptrend. Price is going down. The intermediate term trend is going down, but the long-term trend is still moving up. In terms of consensio, that's as bad as it gets in a bull market until the bull market comes to an end. Now a lot of damage is taking place, and we have raised another 25% when the blue moving average, the intermediate, cut through the long-term moving averages 4 weeks, going into 5 weeks after the price broke through the long-term moving average. So now we've got 25%, 10%, 10%. We've got a total of 45% in cash at that point. We are looking to put that cash back into the market, but we're very worried that this thing could turn into something much bigger, and we're approximately half sitting in cash. Yes, we've got losses in terms of where we had been at the peak, but we're still well above anything that happened in 2017 and going back into 2016. And we've taken profit on that move. Now we're waiting to see. What Consensio is telling us to do is wait and see if the blue line and price stays below the long-term moving average long enough for it to begin turning down. That did not happen. Just the opposite happened. Price went up again, turned the blue line, the intermediate term, up, and then in June of 2018, June of this year, prices and the blue line climbed back above the long-term moving average. We then got another correction down. At this point, we have not put money back into the market because you often get a second test in both directions, either up or down, of major moving averages. The second test came with those 3 gap red negative candles that occurred as we went into late summer, that broke price below both moving averages and brought the intermediate term moving average briefly back below the long-term moving average. Luckily, that bottom was higher than the previous bottom, and price began moving up immediately afterwards, and we've been in a bull market ever since. And incrementally, we put money back in when price went above on the second green candle off that low. We put money back in when the blue line crossed back above the gold line. And as we accelerated above the peak of that second correction, we were fully invested. And now, as you see, for the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks, we're in a bull market. All moving averages moving up, all above the next lowest one on the scale, and the price above each. Now that's getting tested during this week and the previous week. We've got another short-term correction. We've gone below the short-term moving average, but everything else is still intact. I have not taken any money off the table for Dow stocks. We have just recently, within the last 2.5 weeks, gone to all new time highs. So I am assuming at this time that even though we're down 225 points again today, that this is going to respect the long-term moving average and now the intermediate term moving average, and we're still in a bull market. But I'm not married to that position. I am ready to start raising cash if we go down. We're fully invested, and we can do the same thing we did before, and I'll be happy to do it. That's the way Consensio works. Okay, enough on that. I'm not going to spend this much time on each chart, but each chart is very important. The next one is the S&P 500. Everything I just said about the last chart is true in this chart. The difference is here we have cut through the S&P 500, both the short term and the intermediate term, and the short term is now ready to cut through the intermediate term. So depending on how this week ends up today at 4 o'clock, I could very well be taking money out of S&P stocks, not the Dow stocks, but the S&P type of stocks or indexes or ETFs that are related to it, with a preliminary move of a 10% back into cash. Everything else remains intact. And I think the Dow is now leading the way, whereas the Dow has been on the opposite end of the spectrum for a long time. It has been following the other markets. I believe it is leading, and therefore the Dow type stocks are coming back into vogue. Okay, let's take a look at the next chart, which is the Nasdaq. This is the Nasdaq Composite, made up of 2,000 stocks. Everything I said about the previous two is the same as this in terms of January, February, March of this year. We did not get the intermediate term breaking below the long term because this is the strongest of the indexes up until recently. But we did run into a problem here this week when the price dropped below the short term and dropped below the intermediate term. We will very probably close in this region. And if we do, I will be taking 10% off of NASDAQ type stocks because we are closing price below the intermediate term. Price is actually dropping faster than the short-term moving average, but that won't last for long. The short-term will quickly be below the long-term. Excuse me, the intermediate term. We're still well above the long-term, and you can see the long-term is basically a straight line up with no variation in it because we haven't been able to break below it. We did very briefly back at the end of spring. Within that 1 week, it looked pretty bad and immediately bounced off of it the very next week. It's been going higher ever since, besides the 3-week correction that we had in the beginning of summer. Okay, so that's my thinking on that market. Now let's see what's causing all this problem. Here it is. You're looking at it. These are U.S. Treasury bonds. This is the price of U.S. Treasury bonds. And as you've heard, if you've been following the markets this week, this has been a very bad week. Go back a week before, and you see we were basically holding the bottoms of May and the bottoms of early 2017 and the bottoms of late 2016. That all gave way this week. That is the beginning of a big move down in bond prices. Let me repeat, this week is the beginning of a big move down in bond prices. Just off of this chart, but let's look at it from a consensio point of view. Here we see the short-term moving average below the intermediate-term moving average and the intermediate-term moving average below the long-term moving average. That's the definition of a bear market. You also see that the long-term moving average is already turning down. This is a very negative chart. And what it means is higher interest rates. And to understand that, let's take a look at the next chart, which is a chart of the 10-year yield on bonds. We just looked at the price of bonds, which are dropping sharply. You would expect to see this going the other way, which is exactly what it's doing. These are the yields on interest rates. Now, there's a very good side to this story, unless you're a bond holder. Our clients do not hold bonds right now. Even in our balanced accounts, we have been, for this entire year, getting out of bond positions. And that is because of the other chart that, if you've watched us before, is the largest hyperwave of all times, which was the chart of bond yields from 1940 to today, where the first half of the chart went all the way up from 1940 until 1980 and has been going down from 1980 to the present. That has ended now, and rates are beginning a move up. And the question is how fast. The reverse side of it is bond prices going down. Every time this chart goes up, if you own bonds, you're losing money. If you're going to hold those bonds until maturity, good for you. But in the meantime, you're going to have paper losses until that maturity date. And if you have junk bonds or corporate bonds, you can expect very possibly that a number of them are going to be downgraded. And so you will also have loss of principal from the credit side. I won't go a lot into that. We'll do a whole vlog on bonds and interest rates. But just know that these charts we've just looked at are telling a very big story. The stock side of things is still in bull markets going up, and I believe will continue to. The bond side of things is looking bad. How could that be? The answer is the stock market is being driven by corporate profits and economic growth, and by higher wages and better employment. Those are the fundamentals that drive all markets, all economies, but are particularly strong in the United States. What I'm saying is not true around the world, but it is still true in the United States. But we have got a long way to go between now and the elections in 30 days approximately. And a lot can change if the politics changes. If the politics doesn't change in terms of who's holding Congress, then we can expect more of the same, meaning economic growth and corporate profits for the next 2 years. If something does change, that might call that into question. We will do vlogs on that situation as we get closer and closer to election day. Okay, let's look at the last chart, which is interesting to me because this is GBTC. And I've been saying that the premium on GBTC has fallen from over 65% down to 40%, which is his average, down to 30%, which is less than average, down to 20%. And for a very short time, intraday, I saw it down slightly below the 10% mark before jumping back up to 20%. In the past, I made the comment, when the premium on GBTC gets below 20%, it is historically a great buying opportunity. Below 10%, it's a screaming buy historically. It's so rare, and in every previous case, it's been a wonderful place to buy. I said in my tweet, this is not a wonderful place to buy. This thing is headed lower. And I gave two possible reasons why fundamentally that might be. One was because Bitcoin prices were ready to drop sharply, which would then alleviate that low premium on GBTC unless GBTC dropped faster or slower than Bitcoin prices. That has not happened. Bitcoin prices have not dropped sharply since I sent that tweet out, but we still see GBTC dropping in price, as shows up on this weekly chart, and we are now sitting at the lowest point since the peak of Bitcoin and since the peak of GBTC. We're sitting there right now today. I believe this will continue to go lower, which could mean that large institutional money is beginning to bet on the possibility or probability of something coming down the pike in the form of an ETF or an ETV or an ETP or some other foreign but possible to buy in the United States kind of a security that takes the premium and the discount out of this kind of a security. I've been predicting all along that if that were to occur, GBTC's premium would drop down to zero. And it's coming very close to doing that earlier last week and is still not really alleviating the situation, which leads me to believe that either my first premise that Bitcoin prices were going to drop quickly, or that it and or some new security being approved in the reasonable future was causing this to occur. Right now, Bitcoin prices are in a coma. They have not moved even in a small way up or down for the last couple of weeks. Any swing is quickly met by selling, and any downswing is quickly met by buying. It's hanging around the 6,500 area as it has, slips down into the high 64s. It needs to drop below 62 before I will start making comments again on Bitcoin. Otherwise, we're just saying the same thing over and over and over again. None of my targets have changed on Bitcoin. I believe we're about to test the 54 to 5,500 range, which is my phase 2 on the Hyperwave. I don't think it holds the first time. I think we drop down below 5,000 and test tones 49.75. I don't think that holds the first time. I think we drop below 4,800 the Fibonacci final line before 1,000, and it holds. It doesn't immediately bounce it, but price before the end of the week. And we've only got till Sunday, and then we start a new week, which is great because that means if the fall begins after Sunday at 8 o'clock, we've got a whole week for what I just outlined to occur and for us to bounce back above 54, 5,500. We'll give you some exact numbers on that in tweets and in other vlogs in the coming days. But then we have a successful test of phase 2, and then we see what happens. We could run back up to 6,000, 6,500, 7,000, 7,500 off that bounce. But then unfortunately, we will probably come back down and retest phase 2 again, and maybe a third, fourth, and fifth time over coming months. But that would be a successful test of phase 2. And at that point, I will stop talking about us going down to 1,000, at least immediately. If and when we break through the phase 2 line on a weekly closing basis, that's the end of it. We are going to 1,000. I have not changed my tune on that right up through today, and I won't until we are able to test it. But as I have said, Bitcoin is in a coma. It is dead. The eyelids are not fluttering. It's lying there lifeless. It's not doing anything. There is no volume. There's no interest. That's not true in some of the cryptos. Some of the cryptos are throwing in 3, 4, 5, 10% moves to the upside, 3, 4, 5% moves to the downside. Bitcoin is lying there as dead as a doornail. It is not dead. It's just waiting for its moment as it gets closer and closer into the apex of this gigantic triangle to show us its cards. And as Tone believes, and I believe, when it shows its cards, the Queen of Spades is going to come up, and we're going to start a very big move down very, very quickly. Okay, enough of that. Thank you very much for tuning in today. This is a precursor to what we are going to do in great detail for many stocks, many ETFs, many mutual funds using Consensio on indexes and individual securities that many people are interested in, showing how I step aside step by step using Consensio. We will also shift from 2, 7, and 30 period moving averages to other ones and to exponential moving averages to show you how all that works using Consensio. And that is a week from today. Again, please go to lucidfunds.com and just fill out, it's just name, address, phone number of interest in that Consensio webinar next week. You will be able to watch it anytime during the week coming. Not only that day, but that night, whatever your hours are around the world, you can watch it, and then you can continue to watch it for the next week beyond that. So you're not locked into a time period here. I think you will find it very interesting, but we're running out of spaces. And with that, thank you all very much. And back over to Leah. Thank you, Leah, for setting those wonderful charts up.
Everybody, thank you so much. Ooh, I always get reverb. We will talk to you guys later today. I am running to a flight for Northern California, but I will be putting up, as Tyler said, a full information about Consensio and the webinar on our website later today. But if you do just fill out the form, then I will personally send you all the information. And yes, we have about 10 spots left, so definitely fill it out quickly. But everybody have a great day. Cheers from Palm Springs, and thank you, Ty.
Great. Thank you, Leah. Thank you, everybody. Bye-bye.